Hi team, hope you guys are all having a lovely day. Today I'm going to be talking to you about something that really excites me, which is mastering your mortgage, how to reduce your interest costs and to build some wealth. So hopefully everyone's ready to go. So anyway, here we go. So my name's Karen, and I am a performance coach here at Enable Me. And today our agenda is talking about mortgages and finance realities, looking at the external forces that can hold us back, looking at how we can control those, what we can work with, and how we can start training our mindsets. We've got a fantastic client story, which we'll share with you. And at the very end, we'll have some questions and answers. So if you do have questions, please put them forward and my producer will organise to have those on the screen at the very end. So all excited about starting. So today's presentation is obviously for information only. The presentation is not intended to substitute any regulated financial advice. We can do that in another stage. So just a little bit about me. So I had a really long career in banking, so over 30 years. Started when I first left school and decided to retire early and do something completely different. And it's something I absolutely love because I'm able to help people, probably hundreds of people in the past, about getting into homes and mortgages. And now I can spend the rest of my career helping people getting out of their mortgages. So helping you get those mortgages paid off a lot faster, because it's a really, really important thing to do in life. So in my previous life, I was a bank manager for over 20 years. Then I went into manage a team of premium banking managers. I've worked with people with really high incomes and really high net worth. But my passion's always been about helping clients with their lending and the planning for their retirement. So here at Enable Me, obviously we want to help people optimize what your outcome could be and make sure that your progress is accelerated as quickly as possible. So that's what all the coaches here love to do. So we all want to have some financial security. So, I mean, financial security helps us when we go through some volatile times, and that can be things like redundancies or interest rate changes or just things that can happen in your life that you don't expect. It also gives the opportunity for us to choose the life that we want to live as opposed to what we have to live. We have the ability to follow our passions, so to be able to do things like maybe reducing the hours we work, or when we want to retire, or take on a side hustle or whatever it is. But most importantly, it gives us peace of mind. The reality is we are paying too much on our mortgages. So we all know that the banks make lovely, nice, big profits. But I personally think we should be looking at being a bit more proactive where we are putting our money. We do want to pay off our mortgage as quickly as we possibly can, but we want to do it in a way that we can still have a really nice lifestyle and have a good, comfortable retirement. Look at things like overseas trips, helping our kids into great educations, but in general, just having better choices in life. So the difference, this is really an important point that I like to make to people, the importance of paying off your mortgage early is that if you had an average mortgage in New Zealand, which is about 550,000, if the interest rate was around about 5.99 over the term of that mortgage, over 30 years, you will pay the bank over $635,000. That's a humongous amount of money when you're considering you're borrowing 550,000. If you were to reduce it down to 15 years, you're only paying $234,000 to the bank, which is still a lot of money. But if we can get you down to 10 years, it takes it down to about $182,000. So that's a potential savings of over $450,000. That is a huge amount of money. And you can see why, if we can proactively manage your mortgage with you, you can have great savings and get mortgage free earlier. But for a lot of people out there, having come from Auckland, where I know the mortgages can be quite a lot higher, I used to see mortgages for first home buyers in the $800,000 range. So just to give you a comparison, on a mortgage of $850,000, paying that same interest rate of 5.99, the interest you pay over 30 years is a staggering $981,000. That is just crazy. If you could shorten that down to 15 years, you'd be looking at 439,000, still a huge amount. 10 years, about $280,000 in interest. So potentially, if we can get you mortgage free within 10 years, you could save up to $700,000. So that's less money, obviously, that the banks are wanting to give. So I always think about banks and brokers want to lend you as much, and that's great. But here at Enable Me, we want you to get mortgage free as quickly as we possibly can. So how do we achieve getting mortgage free that much faster? So we really need to have a really good strategy that's designed to help you increase your savings rate and to optimize your mortgage structure. So I like to say we proactively manage your mortgage with you. It's not about timing. We're all waiting for interest rates to change and things like that. That does help. That helps a lot. But that is only one thing that can affect getting mortgage free faster. So your plan really starts by knowing what your starting point is. So where you are today, what you want your end game to be, how long you've got between now and the end of that game, and what your behavioral tendencies are. They have a huge impact on what you do with your money. And of course, the hand that you've been dealt. Some people are very, very lucky and, they have parents that can help them, and other people don't have parents that can help. You can have an amazing career, you might have student loans and things like that. So that all impacts on where you're sitting today and how quickly you can accelerate your progress. But the most important things come down to three things. Being able to maximize your savings. So whatever you've got coming in with what's going out, maximizing those savings so we're not frittering those away. Really getting rid of that mortgage as quickly as possible. As I've already said, it saves you amazing amounts of money. It's actually scary. And then once you've got your mortgage down, being able to create leverage so that you can start to build your wealth. So getting mortgage free on your own occupied home is the best thing you can possibly do, but you don't have to be mortgage free to be able to do that. You can just get your mortgage to a really nice, comfortable level, and then you can start looking at other options for building wealth. So our step one is about maximizing your savings. So we have to understand what your behavioral tendencies are and what your cash position is. So your money personality is really, really important. And I've just got to put my hand up and say, I'm a shopper. There's probably lots of shoppers out there. Being a shopper means that you have to have some control in your life. It's really easy to go out and buy things. And you have to be able to stop yourself. So if you've got someone on your shoulder saying, don't do it, Karen, don't do it. Or you can actually have a sort of a little thing that says, right, I'm not going to do this, or I really want it, but I'm going to walk away and come back in half an hour. And if I still decide I really need this, then I'll buy it. Then we have our savers, and our savers can really find it difficult to spend, which is really difficult for a shopper to understand. But savers can actually feel physically sick, not actually, having to spend some of those savings they've put aside. But obviously that can also hinder you from moving ahead. And then we've got what we call our plotters. And our plotters are the people that can shop when they want to, but they can save as well, which is fantastic. But again, is making sure that we can make use of all of the things that we build up to be able to move ahead. Our approach to risk is really important as well. So sometimes we can't do things because we're a bit of a safety ward and we kind of risk averse and we don't want to go ahead, even though we might know it's the right things to do. And then when we've got people that just jump straight in, there are adventurers, yep, we're going to do it. We know this is going to work, off we go. And then our dreamers that would like to do it, they know it's the right thing, but just can't bring themselves to do it. But they have these grand plans. And then we look at our cash position. So where do we feel we're sitting at the moment? So over the times where we've had the higher interest rates, there's been a lot of people out there that feel that they've been sinking, that they're just not going anywhere. They're actually going backwards. And then hopefully with interest rates dropping, they'll start to feel like they're getting ahead a little bit more, but not necessarily, because we've also had inflation really come up and, take a lot of money out of our wallets. And then we've got those that are floating. So those people that are doing very well, they don't have to worry about money, but they're not really moving ahead. They're just treading water. And then we've got the people that feel like they're flying, and that means that they don't have to worry about money. They've got enough, it comes in, don't necessarily have a plan, so they may be flying in a direction where they don't know where they're going to. So it's understanding what our tendencies are and what our cash position is that helps us understand what our next plan needs to be, or help us achieve our plan. So knowing a starting point and your tendencies really helps, but you need to optimize your cash flow. So probably heard a lot of talk from us at Enable Me about fritter, and we believe that about 15% of average income is frittered on different things. Things like trips to the takeaways, supermarket. I always go in and I think to myself, right, milk, eggs, bread, milk, eggs, bread. And I walk out with 2 bags full of stuff that just cost me $100. And it's because I've gone in and just not always been sort of disciplined about what I need to do. Subscriptions can be expensive. So quite recently, I've sat down with clients and we've talked about what kind of subscriptions they've got. And we've got the Neon, we've got Netflix, we've got Spotify, we've got Disney Plus, we've got Google, Amazon Prime. Can't think what else I've forgotten. But they can add up to about $170 a month, which is over $2,000 a year. That is a lot of money for TV and things that you could watch, but you don't necessarily watch. So sometimes it's good to think, have I actually seen anything on that recently? And could you look at getting rid of some of those subscriptions? Mortgage structure is really important, because if you just take out that bank mortgage that your bank or your broker set up for you, and it's over a lovely 30 years time, when you're young, 30 years just seems, doesn't really make too much difference, but that can be really inefficient. So really looking at our structure of our mortgages to actually get rid of that fritter is very, very important. Utilities, it's like Monopoly now. So you have your power bill may include your internet, it might include Spotify. There's all sorts of things that they throw in now. They're all with different companies, but actually making sure that you review those utilities on a regular basis to make sure that you actually aren't overpaying. So it's good to look around to see what the options are out there. And that's, well, no one should be paying those. Insurances are really, really important to have, but make sure that you've got the right insurances for your current needs. And our needs for insurances change during our lives. So when we're a bit younger, we've got big mortgages and families, we might need to have a lot of life insurance. But as we get older and the debt reduces and the kids become independent, we don't need that so much. It's really, really important that we do review our insurances on a regular basis. So crushing our mortgage, that's what it's all about. We want to get rid of that mortgage as quickly as we can. And it's not always about the interest rate. It's often about the pace of how we actually do that. So we have mortgage options, and, a lot of people know this information, but some people don't. So we like to make sure that we're really clear on how things work. So refixing is what a lot of people are looking at doing on their mortgages at the moment. We've got a lot of mortgages coming off their fixed rates this year. A lot of people have been sitting on either floating rates or 6-month terms waiting for the OCR to drop. But if you're refixing, that just means your loan has come to the end of its fixed rate term. The banks will normally send you some new rates, and you can actually just secure those new rates with your current lender. Make sure you always get the best discounted rates possible. Refinancing means that you could look to switch to another bank, and there are advantages for doing this because they may be able to negotiate better conditions for you, and that's always worth having a look at. A restructure is where we want to optimize your mortgage structure to make sure that you've got a lot of flexibility, that if you were to repay some money back, you have the ability to draw it back if you need to in an emergency, or if there's something else that you're wanting to do. And then we have the 2 at the bottom, which is about our revolving credit facility and our offset mortgages. So revolving credit is a great way of being able to pay down your principal quite fast, but it means that you can draw it back if you need to. So the good thing about that is that if you're not using your revolving credit facility, you don't pay interest on it. But if you've got if you are using it and your income goes into it, you can actually reduce your interest cost because your income's going on a regular basis, and also hopefully some of those bills that you don't have to pay as often can sit there, and that builds up that buffer for you. And then we've got our offset mortgages, which is another type of interest rate saving product. And that's where you could have some money sitting in an account. You don't want to use it because you do want to have it sitting there. And that's a lot of our savers feel quite comfortable having money sitting there, but you can offset the amount of mortgage against the amount of money sitting in that account. You don't earn any interest on the savings, but you pay no money on the mortgage that you're offsetting for the same amount. It allows you to have that buffer, but often we find that people will spend it, and then once it's gone, it's really hard to get that buffer back again. If your financial situations change, the bank may not lend you more money, which is why personally I prefer the revolving credit facility against an offset. So financial progress, it isn't normally linear, which is why when we approach your finances, we look at all the different options that are available to you, and we want to make sure that you have flexibility in your lending. So that's why financial planning is absolutely crucial. But of course, being mortgage-free isn't the end game in itself. As I say, some people like to get their mortgage down to a level which gives them other options of doing other things. I've been mortgage-free myself a couple of times, and it always ends up that great, yay, mortgage-free, but now I want to do something else. And so, it's a great thing to aim towards, but once you can get that to a level that is really comfortable that you can repay it easily, then you could look at unlocking other options to you, other pathways and opportunities. And that's about leveraging. So leveraging is fantastic. So leveraging means that you're borrowing money against your property to buy something else. So an investment property normally. And then the money that the bank lends you actually grows in value with the other asset that you've just bought. So that's money that you don't already have. Whereas if you were to save money and want to invest it, you actually have to save it. This way, we're using it before you've actually saved it, because what you've actually done is got your mortgage down to that really comfortable level that you can borrow against it. And that's how we can build wealth. So we talked about having a great story to share. So this is one of my colleagues, Liz, her clients. So back in 2017, Luke and Jake joined Enable Me. They're in their mid-30s. They had a mortgage of $700,000, and their loan term at that time was 30 years. When Liz sat down with them, she was able to work out what their life cost them, what their surplus was, and then look at how we could optimize their mortgage. And we projected that they would have that mortgage paid off in 12 years, which is huge compared to 30 years. And if you go back to what I spoke to about earlier, the interest savings, you can imagine how much they would have saved being able to pay that over 12 years. But they did it in 4 years. And during that period of time, they purchased a new car, they renovated their home, they got married, they traveled overseas, they actually purchased 2 investment properties, and they overcame employment setbacks. So one of them was actually made redundant. So that is amazing what you can actually do when you've got a fantastic plan and you've got focus and you've got somebody holding you accountable for what you're actually doing. So I just think that's amazing. So what that gives you the opportunity of doing is, if you can get mortgage-free earlier, you can see there, if you could get mortgage-free by the time you're 55, that gives you all of that time, another 10 years to grow your wealth. And by growing that wealth, that puts you in a better position for when you do go to retire. It means that you've got more options in retirement, because I don't know about you, but I don't think I could survive on $27,000 a year on the National Super. And for some people, National Super might be at the age of 67, might not have a lot of control about what happens with National Super in the future. But by building the asset base from 55 to 65, it gives you that better lifestyle in retirement. Whereas if you drag your mortgage out to the age of 65, you've got pretty much no time to grow anything, and then your money will be spent very, very quickly. And you might be relying on super or whatever it is that you're going to be relying on. So it is really important to focus on getting mortgage free as quickly as possible. So here at Enable Me, we are financial coaches. So a coach is somebody who tells you stuff that you don't want to hear. It sees the things that you don't want to see, so that you can do and be the person that you want to be, or who you know you could be. And that's a quote by a famous American football coach. I always liken it to when you go to the gym, and when you've got a personal trainer there, they teach you how to do things perfectly. They expect you to be at the gym 3 or 4 times a week. But if you don't have that accountability, you might not do your exercises and get to that potential that you could do, and you might not actually go along to the gym because you're wanting to do other things. So having a financial coach helps give you accountability and gives you lots of encouragement and keeps your plan live. So some takeaways from today. Understanding what the problem is that you need to have solved, understanding what your tendencies are. And as I say, I'll put my hand up. I'm a shopper. I know I need to have guardrails in place to stop myself spending money. Remove all the inefficiencies, taking out all of that fritter, understanding what our fritter actually is, but still being able to live a really lovely, comfortable lifestyle and get mortgage free at the same time. Create better systems to save. So that's all about your account structure, making sure it's set up in such a way that you don't overspend. You know what you've got to spend and what you can put away to save and accelerate your mortgage payments. And really focus on the execution of your plan, because a plan at the end of the day is a piece of paper, a few pieces of paper. But execution is the difference between moving ahead financially or just having a great plan but not actually doing anything with it. And then when things change, we have to adjust, we have to reset, and then we move on, we move forward. So today, because you've joined us on our Lunch and Learn, normally financial consultations are valued at $400, but because you've come and sat with me today for the Lunch and Learn, you can actually get your first consultation with Enable Me for $149. That's if you book today. If you book after today, the consultation is $249. So that is a great saving already. For all the savers out there, fantastic. For the shoppers out there, you've just saved yourself quite a bit of money. So I think that's fantastic. So Amelia, do we have any questions?
Yeah, so we've got some great questions that have come in. So the first question is, someone said, I'm hesitant about using revolving credit in our household. Do you have any recommendations for how I can structure my mortgage to pay more off each month without the funds being easily available for spending, but still available for emergencies?
Yeah, absolutely. I can understand that. Revolving credits facilities are very, very interest efficient, which is why we like to use them. But we wouldn't put anyone into a revolving credit facility until we understood your behaviors and putting guardrails in place that if you did have a revolving credit one, it wasn't a huge limit. It was just enough that you could repay over a short period of time. If you don't feel comfortable with a revolving credit facility, you would be working with a coach that would look at those surpluses and then on a regular basis find out ways that you can proactively repay that money. We want you to be able to draw it back if there is an emergency, which is why we do like the revolving credit facilities, but everybody's different. And that's why for the first 12 weeks of our programs, we test your spending targets, your spending plans to see whether or not the amounts that we've set up are correct. But a coach will be able to help you with that. That's quite, it's quite personal because there could be a reason why you don't like those facilities. Hopefully that answered your question.
Thank you. Our next question is it better to save a lump sum to pay off portion of the mortgage when it comes time to refix or to increase payments marginally?
Um, I I think a lot of people think you have to wait until your mortgage comes off its fixed rate before you can make a lump sum payment, but you can actually make lump sum payments normally anytime during your fixed rate. So you do need to check with your bank whether they've got any kind of criteria over there. Some banks you can pay off $1,000. I would be checking to see whether or not you can make smaller increases on a more regular basis. If you can't, you can normally increase your mortgage payments, which is accelerating your loan payments. And again, the banks do have criteria of how much that could be. It may be up to an extra $1,000 a month. And that's another way you can actually help get rid of your mortgage faster. Ideally, that doesn't give you much of a buffer because you can't actually, in most banks, draw that back, which is why we need to chat about building a buffer for you.
Another question that came in is, do you have any practical tips for helping kids to understand the concept of money?
Okay, I've got a 20-year-old daughter, so a lot of experience with this one. For me, it is quite hard to say no, but I think if you can say, look, we could do this, but if we do this, it means that we're going to sacrifice something else. So if you want me to buy those shoes for you, that's fine, I can do that. But that means that we're less likely to go on the holiday to Fiji. So make them understand that there has to be a trade-off. The other thing is, don't let them just get their pocket money for doing nothing. They have to work for it. So don't set up an automatic payment to give them $20 a week or whatever they get. Only give it to them if they've actually done their chores. That's another point, because that makes them see that they're adding back into the household. It's not about them getting free money. They have to actually help out at home. Another strategy that you can do is if it's a bit of a bigger purchase that they want, ask them, what aren't they using anymore? If they've got toys or games and things that they no longer use, could they sell that safely on Marketplace or wherever to actually help finance the purchase of whatever it is that they're wanting to buy? I think including your kids in your financial decisions and discussions is actually really important, because otherwise, how do you learn to manage your money better if you haven't learned it from your parents? So creating financially independent kids is very, very important. Have limits. Have limits for Christmas, shopping, think for Christmas gifts, spend $200 on Christmas and $100 on birthdays, but limit what you spend on them. Because otherwise, when they leave home, they've been used to this great lifestyle where they don't have to spend anything themselves. They go out to work, they can't afford that lifestyle, so they end up getting into debt with afterpays and credit cards and things like that. So I think setting them up now is a really, really important thing to do. And it helps you because that's money that you put back into paying off your mortgage and actually getting ahead yourselves.
All right,
Anything, Amelia?
last question.
Mhm.
Can the financial consultation be done online, or do we have to come to an office?
No, hey, look, we're really good at Teams. So we've got coaches throughout the whole country. So they can be done on Teams if that's if that's easier for you, or you can come in and join us in one of the offices that we've got throughout the country. But yep, Teams is absolutely fine.
Thanks, Karen. I can see that a lot of people have asked questions about our financial consultations. We've
Mhm.
run out of time for now, but please feel free to give us a call on the number on our website or email us. We have a lovely onboarding team who will be able to answer your questions about these financial consultations. I'll let you close off for now, Karen.
Yeah. Hey guys, look, we'd love to see you at Enable Me. The comment I get so often is we should have done this 10 years ago. And if you don't do something today, you will keep doing what you're doing. And if you keep doing what you're doing, you get the same result. So it's really important to take the first step. Come and talk to us. Our coaches are absolutely amazing, and we're all here wanting to help you guys get ahead with your finances and with your life. So, yeah, please come and see us. We'd love to talk to you. Anyway, that's it for today. I hope you've all enjoyed the session. I've really enjoyed it. And yeah, let's get mortgage free faster and grow lots of wealth for our retirement, and have a great day. Hope to see you soon.